So Kevin is actually going to be linking everything below. So everything that I mentioned, their website, their social platforms. I know that they got a really good community on their social platforms. And so they're always tweeting at us and reposting our Facebook posts. So that's awesome. And we have a really good relationship with them. But today we're going to talk about property insurance options for investors. So if you are any kind of a real estate investor, listen, and he's going to share that with us. So we're super excited. So Shawn, I'm going to come right back around to you and introduce you. But first, we're going to talk about a couple of things that we have going on. So a lot going on, good success. In May 9, 10, and 11, we have our second quarter mastermind. And Shawn is actually a part of that, one of our original members. So Shawn's been at every single one of our events. And so he's definitely a cornerstone member for us. And I'm sure he loves it to death because he just won't leave. So in a nice way, you won't leave. That's a good thing. So, but our mastermind is coming up May 9, 10, 11. If you guys are interested, go to goodsuccess.com/mastermind. Kevin's going to link it below right now. And you guys can check that out there. For some more information, we bring elite real estate investors from across the country into one room, collaborate, network is the biggest thing, and then help solve each other's problems, bring value to everybody. And it's just an awesome event. We love it. The mastermind community is growing very big, so we're excited about that. And so the next event is in May. Guys, go check it out. We do have you guys fill out an application, so we don't let just anybody in. We do vet your number, so it's not, it's the value of the room is very, very large, but also the character and the type of people that are in the room. We also vet that as well, so that we have people in there that are, on their way to good success. And so we're excited about that. And then the next event we have coming up in July. I know it's far away, guys, but we only have 80 seats for this. And Shawn is going to be speaking at this one as well. So the Community Go-Giver events, we're going to be teaching you guys some things on building your community. And I'm actually going to pass this over to Tom because he's going to be able to explain it a little bit more. But we have a heavy hitter lineup. I mean, we got Walter Wofford, Jim Ingersoll, Jeffrey Taylor. Shawn's going to be there, Gary Harper, Ken Lacey. It's just going to be an awesome event, 3 days, July 25, 26, 27. We only have 80 seats available. So Kevin's going to link it right now. You guys, go get your tickets. Tom, let's talk about it a little bit.
The Community Go-Giver event, I have a vision to flip the city of Gary. And I'm going to kind of open that up a little bit in the opening remarks. And I'm going to talk about that a little bit and a little bit about my vision, just starting into that and getting going with that and actually talking to some people this week about that, and we have some more meetings scheduled next week with some Army people, and to be able to work with the government to be able to make things happen as well. But I'm going to talk about that, and then the first day is really going to be more about fix and flip, and then Gary's going to come in with processes, and we're going to have Jim Ingersoll talking about fix and flip the second day, about owning rentals, property management, having the proper insurance. With Shawn, Jeffrey Taylor's going to be there. If you guys haven't heard Jeffrey Taylor, I mean, amazing stuff when it comes to that. And then the third day is going to be about low-income housing. Walter Wofford, if you guys know him, if you're in the Financial Friends Network. If you're not in the Financial Friends Network, I highly recommend it. I highly recommend anything Walter does, but also going to talk about low-income housing, how to structure deals that you can put them in trust, you can do tax-free deals, and then also to follow that up with Quest IRA will be there as well, teaching about how to invest with invest your money and tax-free. So that's really the whole circle every single day. So the first day, we're actually going to go out and see a fix and flip house that we've just completed. The second day, we're actually going to show you what our turnkey rental product looks like. So if you're looking for turnkey rentals, this is a great place to come see what we consider turnkey rentals should be and what the standards should be. And then the third day will be low-income housing. So if you're adventurous and you want to go out and see what low-income housing looks like,
we got plenty of that.
We got some of that too in this area. So we're going to do that. Every single night is going to be capped off. I shouldn't say every night, Tuesday night. So I'd like for you guys to come in early. Tuesday night, Wednesday night, and Thursday night is going to have a networking event at my country club right up the street here, about 5 minutes from my office. And we're from 6 to 10, I think we'll have a networking event every single night if you guys want to talk more with the people. Also, just so I think to add something that's huge value to you, every single person that comes is going to get 1 to 2 minutes to be able to say, this is who I am, this is where I'm from, this is what I do, and this is why I came to this event. And I want you guys to be selfish about it to a certain degree. If you're a lender and you're looking to be able to deploy money, tell them, I'm looking to find trusted people that I can put my money with. If you're a newer person and you're looking to find money, I want you to say, I'm looking to find private lenders. If you, doesn't matter what you are, if you're looking for knowledge, if you're looking for network, if you're looking for influence, all those things, I want you to tell us what it is, and that'll help the networking time be more valuable. So I'm going to give it back over to Josh, but that's the Community Go-Giver event. I'm super excited about it. If you want to be able to say in 10 years, when I believe this event's going to be 10,000 people coming to this event, I was at the first one, you're going to want to be here in July.
Absolutely. So communitygogiver.com. Kevin's going to link that below right now. So the mastermind, the Community Go-Giver event, and then we're going to bring it back over here to Shawn. So Shawn, awesome to have you on the live feed here. If you guys are joining the live feed right now, if you're watching this post-produced, then thank you guys for watching. But if you're watching it live right now, make sure you give this likes and also share this around, because we want to get the word out from what Shawn's going to be sharing, because it's extremely important to the real estate investing community for you guys to hear this. So share this around, leave some comments below for us, and we'd love to connect with you guys. So Shawn, if you could just do me a favor and introduce yourself. So Shawn is actually a part of our mastermind, like I said, and he's been there since the very first event that we've had. And so he has a really good relationship with Good Success, and we have a really good relationship with NREG and everything. So Shawn, if you could just introduce yourself and then maybe talk a little bit about what NREG can provide, and then we're going to go ahead and jump into today's topic.
Sure. Thanks, Josh. And Tom, of course, you did a pretty good job. So I'll try to feed off a little bit. But my name is Shawn Woedl. I'm with National Real Estate Insurance Group. We are a national independent insurance agency, active and doing business in all 50 states. About 20 years ago, we built what is now called the REI Guard insurance program. And what REI Guard is an insurance program geared specifically for the residential real estate investor. So it's very unique as compared to pretty much anything else that's out there on the market. So it's not so much what we do, more of how we do it. So we found a need in the market going back, like I said, nearly 2 decades, where we had clients and friends of ours that were in the fix and flip business, right? So a lot of the home investors trying to get short of this industry wasn't responding to their need. They were kind of looped into having to buy longer term coverage with hefty minimum earned premiums. And if they had interest in a property for 30 or 60 days, they were paying premiums for a full year. When they flipped that property back, so ate away from their profits. So what we did is we built a program to kind of alleviate all that. So starting with Renovators Insurance and now kind of going into National Real Estate Insurance Group, we've developed a program that can accommodate for a location through any phase of occupancy. So whether the location's occupied, vacant, undergoing renovation, if you've got a portfolio that has a combination of the three and you're fixing and flipping as well as buying and holding, what we've done is been able to build a master schedule for each investor and allow them to add and delete locations throughout their policy time with us.
Awesome. That's some good stuff. Definitely filling a void in the marketplace. So that's really good to hear. So Shawn, let's go ahead and jump into it. So we're going to talk about specifically, there's a couple of topics. The first one, let's talk about the property insurance options for investors, and then how they can control those insurance costs, because I'm sure there's a big void out there in the marketplace that, you guys haven't even tapped into yet with some of the markets. So go ahead and let's talk about this topic. This is highly important. You guys listen up and take some notes. So Shawn, go ahead and take it away.
Yeah, thank you. And we talk to so many investors every day, and the most common thing we see is that they're coming into, we deal with a lot of newer investors, maybe starting off 1 to 5 locations in their portfolio, and they're trying to grow. And they've dealt with their local agent that has an agency there at the end of the block, whether it's Farmer, State Farm, one of the other household names. And they say, hey, I picked up a location and it cost me $10,000 to pick up, and my insurance company is wanting me to insure it for $180,000. I can't figure out why. Well, we found a need in the market to be able to accommodate for the needs of investors, right? So not overpaying for coverage and knowing that not all coverage is the same. So the biggest thing that we try to point out to our investors when they come to us is that you've got choices, right? So you should not be able to, an agent should not come to you and say, hey, here's my quote, take it or leave it, right? You've got to understand you have options, whether you go with replacement cost versus actual cash value, whether you look at basic form versus special form, whether you look at some different deductible structures. So there's several things that can go into that can really save you up to 30, 40, 50% on your insurance cost by changes based on what your business model is and the risk that you're comfortable taking on. So, if we look at actual cash value versus replacement cost, the first thing I can tell you is that, obviously taking into account that if your lender is going to mandate that you have replacement cost coverage, then you kind of have to do it. But looking at actual cash value is another viable option. It's something that can save you 25 to 30% per year on your insurance costs. So The difference between the two is being such as actual cash value is going to allow you to insure a property to a lighter valuation per square foot, and in return figures depreciation into the one and only settlement that's available to you following a loss. So think about, what you would do in the event of a total loss. So when we're dealing with investors, we try to steer away from the partial losses. You get insurance on what are retail costs. Always your own retail costs. And investors aren't paying retail for labor and materials. So those kitchen fires they're partial losses that are just headaches and kind of thorns in your side, and probably 70-80% of what the market sees, you're getting those rebuilt for substantially less than what State Farm or Lloyd's of London thinks you can. You have a better grasp on your market than what they do. So think about what you do in the event of a total loss. If the property were to burn to the ground, would you want to rebuild it? Or would you clean the land up, sell it, and go buy another investment property just like it? And that should really be the deciding factor on whether you're going to carry actual cash value or replacement cost. Because again, actual cash value is going to figure depreciation into the one and only settlement of your loss. Replacement costs will give you the ability to go back and recover that depreciation that was initially taken from you. But in order to do that, you actually have to make the repairs to the property. So if you would not repair the property if it were to burn to the ground, there's no reason to pay an extra 20 or 30%. You have the ability to do so because you're never going to recover it. Okay. We can go through a quick example, Josh, if that makes it easier.
No, okay. Absolutely.
So, I mean, let's just take a total loss at a location, maybe a dwelling that burns to the ground that's worth $100,000. It's insured to $100,000. The adjuster is going to come out and they're going to figure out how much useful life was left and what was damaged. And everything depreciates at a different level or at a different speed, but you can say roughly 1 to 2% per year, with an exception of the roof. Especially in the Midwest, that's going to depreciate at an accelerated level due to the constant exposure to weather, obviously. But if we say 1 to 2% per year, and on average, let's just say that across the industry, the average depreciation is roughly 20% off of a loss. So right off the top, they're going to take $20,000 in depreciation off that $100,000 total loss, leaves you with an $80,000 settlement, right? Then they're going to look at your property deductible. Let's make it nice and easy and say it's $5,000. So on an actual cash value settlement to cover that $100,000 total loss, you may make $75,000 in this example. Now, whether you're on actual cash value or replacement cost, that's your initial payment. If you're on actual cash value, that's all you're eligible to get. And by the way, that's why you have insurance. So if you don't want to rebuild the property, you don't have to. Clean the land up, sell it, take the profit, go on vacation, buy a car, do what you want. That's why you have insurance. But if you're on replacement cost, you've got the ability to go back and recover that $20,000 initially taken from you. In order to do that, you actually have to exhaust the first $75,000 that they give you on repairs, make the remaining repairs out of pocket, then you're going to submit those receipts to the insurance company, and they'll reimburse you for up to the $20,000. So the deductible in that case is the only thing that you're not able to recover. That's the amount you're agreeing to self-insure.
So let me just talk about how I look at this for my own insurance and for our own properties. So if it's a fix and flip and it's a house that I'm buying for 150 and I'm putting 70 or 80 into it, I'm going to sell it for 400 grand or something, or 300 grand, whatever the numbers end up being, I'm probably going to end up with I want replacement cost, because I mean, for me, that's going to cost me a ton of money if there's any kind of loss, really. But on the flip side, if it's a $30,000 or $40,000 rental, I might really be looking at cash value. So, and I'm not saying that that's going to be a hard, fast rule for everybody, but at least for me, that's kind of how I look at it. The other thing that me and my closing director, which also helps in finance and kind of like keeps this stuff in order for me, my insurance policies, we review these about every 3 or 4 months just to kind of make sure, that we don't have the wrong policy, or we might need to change policy. We might need to update or whatever. NREG has a really great program for you to be able to put properties on and take properties off. So we don't have a problem with that. And that's in our processes internally with our company. But I still think there's things that change in your life, and there's things that change in the way you think about your different properties. Like, for instance, I may have thought a house at one point may have been a fix and flip, and then later it was a low end fix and flip. So maybe I end up keeping it as a rental, and maybe I changed the way I think about that. So that's something I would definitely recommend everybody do, is review their policies often.
Mm-hmm.
Yeah, and that's a great point, Tom. And that's one of the reasons that monthly we send you an inventory report that kind of gives you an opportunity to do that, so it can compare to your records and what you currently have. And you're exactly right; those things your needs can change. I mean, you may have one that was a complete beater when you picked it up, and you knew that if it burned to the ground, you probably wouldn't rebuild it. 6 months or 8 months into having a thing, it's cash flowing very well for you, where your plans would change. If it burned to the ground, you probably would rebuild it. And at that point, we need to revisit, looking at replacement costs as opposed to actual cash value. And you made a great point as well on the fix and flips or on the builder's risk type of deals. be very careful too with the builder's risk policies that are available to purchase for investors. Many of those have hefty minimum earned premiums, and they're always settled on invested capital at the time of loss, meaning your purchase price plus any immediate renovations or your betterments improvements that you have into the property at the time. So the advantage of working with National Real Estate Insurance Group, working on monthly reporting, is your ability to increase your insured value month over month as you have allocated additional funds to the property. Most carriers are going to require from day one, hey, what's your purchase price? What's your final price after, and you have to insure it to that from day one. Well, if you pick up a property for 50 grand, you're going to put 200 in it. They expect you to insure it to 250. If it burns to the ground on day two, you're not getting paid 250, right? You're the most you're going to make on that 50,000. So now you paid more for insurance than what you should have.
Yeah, and I think that kind of brought up something else in my head, especially in today's market. I mean, I'll tell you, at least in my opinion, one of the biggest opportunities I see in the market is buying houses in that $40,000 to $60,000 range. I think that we're going to see the most appreciation percentage-wise, at least in that market, over the next 2 or 3 years than any other market, because nobody can find yield anywhere, and those people are just going to be rushing towards those. So what's going to happen, and what I'm already seeing happen, is, you know, we're buying a house for 60 grand, or this just happened to me. We bought a house for 60 grand, and I went back and looked at what it's worth today, and I bought it like a year and a half ago, and now it's worth like 100. So like, you have to go back and revisit as the increase in value of the properties go as well. I mean, you want to just, I mean, to me, in that house had a replacement cost on it. And I'm thinking to myself, well, I want to make sure I have it, you know, fully insured, and make sure I'm insuring it properly as the values increase or maybe decrease at some point in time as well.
Have you ever had problems with that with clients? That's probably a good question, right?
It's a great question, right? Because I'm sitting here thinking, wow, Tom's bringing up a great point, because it's a double-edged sword. So allowing the flexibility for investors to insure their property for what they want to is a phenomenal idea, and it's worked very well for us. But if you don't take the time and revisit that, then yeah, you could potentially get dinged following a loss. You know, you didn't update it and think that, you know, and increase the value as you need to. A lot of carriers do that automatically. We don't. We trust that our investors have a good grasp on their market and understand what it's going to cost to rebuild, probably better than even we do. So yeah, it's something you should definitely revisit, and that's something that we try to do every year at the care process. So beginning 90 days out from your annual renewal date, we actually start a client account review, and where most carriers try to find a way to increase cost on you, we kind of do the opposite. So we'll look at the performance of the account, we'll look at the claims activity, we'll look at the growth, certainly the payment history and several factors, and try to find a way to decrease your costs, or at the very least stay flat, right? We want to do everything we can to help our investors manage their portfolio without doing, you know, exhausting a bunch of time and unnecessary money. It's in our advantage to do so, right? You grow, we grow. But yeah, at the same time, we'll revisit those insured values for an investor as well. So
you just mentioned that some insurers will automatically make that change for their clients, and you guys don't. Can you? Yeah. And I know that you said that, you know, your clients probably have a better grasp on the market than what you guys have. But can you go into a little bit of detail of why you guys actually do that as opposed to automatically doing it?
Yeah,
so that people that are listening can understand that a little bit better.
Sure. Yeah. Well, and the ones that automatically do it, guys, are oftentimes the insurance companies that don't have an appetite for the market that we're in. They're offering commercial insurance on investment properties, kind of out of a sense of obligation to their existing clients that maybe they have home and auto coverage for. They want to eliminate them going somewhere else, but in order to do so, they're bumping up rates. They're requiring an insured to insure a property for a much higher value per square foot than what the property's worth. And that automatic inflation every year comes with that, so they can collect enough additional premium to offset the risk they feel they're taking on. So for us, you know, there's no guarantee that's going to happen. So there's really no guarantee there's no reason we should absolutely charge for it on every location.
Mm-hmm. Okay. Awesome. All right.
I mean, yeah. What the very first time I saw you, Shawn, you got up and you said, insurance companies are not in the business of paying claims. And I'm like, finally an insurance person that's honest, and finally an insurance person that says, hey, I'm not only going to tell you that, but I'm also going to tell you these are the pitfalls and these are the things that you need to think about. And I think you had a 13-point or 15-point presentation about that. You know, if you want to link any of that stuff below, or if you have any of those maybe other presentations, I think they're extremely valuable for the actual investors. And I know you're going to do a presentation at our event about something like that. But
Yep.
To me, it was definitely an eye opener. And I went back, and this is when we started making sure that we reviewed all of our policies. So insurance companies are not in the business of paying claims. So they put a lot of things in their policies to try to keep themselves from paying claims, right?
Absolutely.
But I think it's very important for you as the investor to understand that if you don't have an agent that's actually sitting down with you and explaining to you and letting you know up front what they're going to pay for and what they're not going to pay for, and if you want this to be paid for, this is going to be an extra rider, or this is going to be an extra thing on your insurance, then you need to find somebody that like NREG that does. I'm not saying NREG's the only company out there. I think that they're great, and it's who I use, but you need to find somebody that you can trust and that you can sit down and go over all of your policies with. I mean, I think we have over 150 policies or something with you guys, or it's one policy, but 150 properties. And when that, I mean, it's a scary world if something ever were to happen. So just make sure that you're reviewing these and make sure that you're talking to your agent and you know what you're being insured for.
So I assume that kind of everything we just talked about kind of plays into controlling their insurance costs, correct? Or is there anything that you want to expound on more with actually controlling insurance costs?
No, it certainly leads right into it. I mean, we can look at a couple of different property forms that are available to investors, and then certainly the deductible piece and how you have to be kind of careful on the property portion of that thing so that you don't get burned, right? If we touch on the property forms, typically an investor is going to have a basic form option and a special form option that they can choose from. And, taking into account, who's making repairs at your property, if they're renovations, where your properties are located, if they're vacant or if they're occupied, all these things need to figure into what your decision is on whether it's worth paying an additional 25 or 30% more for a special form policy. So when you look at a commercial insurance standards or ISO form policy for residential real estate properties, special form is really considered all risk coverage. So unless there are specific exclusions that are listed within your policy, then coverage is afforded to you following the loss. So the burden of proof actually falls on the insurance company to prove to you as the investor and me as your agent that the loss that happened occurred from an excluded peril. It's very difficult to do. Now, there are 6 standard exclusions on special form, the same everywhere you go. They're mold and fungus, wear and tear, sewer and drain backup, earthquake, flood, and then intentional tenant damage, which is the one nobody likes to hear. It's an uninsurable risk, right? Other than that, though, unless you're located on the coast, tier 1 or tier 2 counties, and you've got a named windstorm exclusion, that's typically it, right? You can have manuscripted policies that are special form excluding theft, and you certainly have to be careful of that. And I always tell my clients or potential clients, hey, go to the back pages of your policy, look at the exclusions and endorsement pages. That's where you start. That's going to tell you what's covered and what's not, and then start your questions from there. Now, if you're basic form, if you want to best protect your assets, special form is the only way to go. Okay, basic form is another option for you to consider, and again, it'll save you 25 or 30% per year, but comes with a few additional exclusions. One of those is theft coverage. So on basic form, there's no coverage for theft. You got to think about theft as somebody ripping the copper out of your walls or stealing your AC unit. That's why I said think about your portfolio. If it's an occupied portfolio that's in a good neighborhood and you don't have problems getting tenants in and out of there, that's probably not too big of an exposure for you. If you think about water damage, think of water damage as internal type water damage for coverage for, maybe frozen pipes that burst in the winter. So if you're investing in Texas or down south in Florida, something like that, maybe not that big of a deal to you. Weight of ice, sleet, or snow, again, depending on where you're investing. Falling objects, which could be anything from space junk like you see on the commercials with Farmers or State Farm, whatever it is, and or something off an airplane, stuff that doesn't happen, right? So if you're willing to self-insure really the theft piece of it, and then water damage, basic form might be a really good option for you to consider to save some additional money every year.
Awesome. All right, so we can go ahead and jump into the next point then. So the property, this is something that we kind of didn't plan before we came on here, but then when we jumped on the call with you to get this thing started, you said you wanted to mention this. So property deductibles impacting your property rates. So I don't know about this topic, so I'm just going to let you take it away, and then we'll chime in as we go.
Well, how much does it actually impact your actual rate? And what are you seeing in the marketplace for most investors, and what kind of deductibles is normal?
Great question. So it can be anywhere. It can be upwards of 20 to 25% difference in your cost, depending on the deductible you carry versus the deductible you're comfortable with carrying, right? And The average investor in our program, we've got about 90,000 locations for about 18,000 investors. Most investors are going to carry 2,500 and up. Okay. Understanding that the property rate that's assigned to you by the carrier is directly affected by the property deductible that you carry. So higher the deductible, lower the property rate, right? More, call it, more interest in the game than maybe carrying ones that are a $500 or $1,000 deductible. And by the way, 2,500 is the minimum that our program actually offers, because we've done that over 20 years, and that's what our investors want to carry. And by being able to offer that higher deductible, it's actually helped us stabilize our property rates long term. So rather than going with a lot of other carriers and then kick you with a 20 or 30% increase year over year, that we simply don't do that. We're able to stabilize our property rates long term and actually not having a across the board rate increase in over 10 years. So the deductible structure is important, probably more vital than what any other agent will tell you, and can actually help you stabilize your rates long term. I would tell you to look at per location versus per occurrence as an option for you in a majority of states. Our program's unique in the respect that we can offer per occurrence, which really means nothing if a fire breaks out at one location. But majority of the country, your major exposure is wind and hail. Okay, so if we have a portfolio of locations, let's say you have 100 of them, and and you have a hailstorm drop down and damage multiple locations. With us, you could potentially have a single deductible to cover that entire occurrence, starting at $2,500, instead of having a deductible assigned to each damaged location, which, as you can imagine, if you get hundreds of these things that are damaged, it's going to get very costly to the investor out of pocket. So the reason we did that is, if you go back to 2008, I was still in Cincinnati along with Tim Norris, who's one of the owners, and we had a lot of clients through, and obviously in that area and up through Dayton and Columbus, and Hurricane Ike went through. And who would have thought a hurricane would do that much damage in Ohio? We'd never seen it, probably will never see it again, right? But had our insureds at the time had per location deductibles as opposed to per occurrence, like what we had for them, many of them probably wouldn't be in business because they wouldn't have been able to stomach all that. So it became really a point of clarity for us, and one that we had to stick to, and we've done our best to do so. I would tell you that's one of the things that I would kind of push our investors towards, is look for a per occurrence deductible. Maybe look at a 2,500 to a 5,000, even 10,000, depending on the size of the portfolio. I'd say think about the minimum deductible that you'd ever turn in, or the minimum claim you'd ever turn in. Double that amount, and that's about the deductible that you can carry without it damaging your business, right? And again, that's tier 3, so not a tier 1 county that's touching coastal waters or one county removed. Look at a per occurrence deductible option as opposed to per location, which is available in many states. That conversation changes very much, though, when you get into tier 1 and tier 2 that are touching coastal waters and have a hurricane exposure. So I'll throw a lot at you here, and hopefully it's not confusing. It's insurance lingo, so it's not the most interesting thing in the world. But if you look at that,
you're good at making it interesting, though. So
I'm trying, man. It's just
I'm telling you, I'm pretty interested, because when you own a bunch of property, you're pretty interested in making sure.
You better be interested.
If you're not interested in this, that's fine.
Costs you a
I'm
lot of
telling
money.
you, when you're in the business, you better be interested.
Yeah. So we see a lot of these come to us, and certainly fortunately we're able to fix it. But let's just say we have a same portfolio of that 100 homes that are sitting in Florida, and maybe they're carrying hurricane coverage, which only about 50% of the residential investors in our program do. If the lender doesn't mandate it, they don't necessarily cover it. They'll take on the risk. But
so why do they do that, though?
If they're contractors and they can fix the roofs themselves, and they're not worried about that exposure, they kind of roll the dice. I mean, if you look at it, Florida's been, knock on wood, very calm up until Irma, which turned out to be, thank God, a bust, right? So for the most part, so a lot of them are rolling the dice right now. But if you were to take 100 locations, and you take, let's just say $100,000 of insured value at each location, you've got $10 million in assets, okay, sitting in Florida. If you have a per occurrence deductible in Florida at that point, which is always going to be a percentage of your total insured value because of the higher risk associated with those wind losses, let's just say most of those carriers are going to go 5%. So you potentially have a $500,000 wind hail deductible on your $10 million of assets. So if you have a per occurrence deductible, if one of those locations is the only one that's damaged out of your entire portfolio, because you've got a per occurrence deductible, you've got a $500,000 deductible.
Yeah.
Okay. So when you go into tier 1 and tier 2 and you're including named windstorm, you got that rule changes completely, and you need to go with a per location deductible only. So if you've got that one location insured to 100,000 that has a 5% deductible attached to it, your wind hail is $5,000.
Wow.
So what's the difference in price in the per occurrence and per property?
Yeah, when aside from Florida, which can be very, very drastic between the differences, obviously, a carrier that's looking at a per occurrence deductible of $500,000 would probably write that account for next to nothing because they literally have no exposure. Depending on the carrier, it can be very different. With us, we don't really, maybe a 5% difference. I would tell you just off the top of my head. So if I get an investor in Missouri or in Kansas City, so if it maybe has 100 locations and wants to look at a per occurrence as opposed to per location, usually that per location, I financially, I can't make it make sense for them to do it. I think it's more of a protection. Plus, I don't really want that argument, right? I want to make sure I'm doing the right thing for my client. I don't want them to come to me and say, hey, I've got 20 of these things that are damaged and now I've got, $50,000 out of pocket. I want to do what's right for them on the front end, educate them and help them make the right decision.
Right.
That's a lot to take in.
Yeah, a lot.
But that's the difference though, right? Like Shawn and NREG, they'll work with you on this. They'll make things happen. So it's totally understandable. I mean, so can you give us a situation? I'm sure you have tons of them. Every time you come to the mastermind and present, you always have a new one. So
Right.
Give us a couple situations where something happened to an investor's property and they wish they had done this with you guys specifically. It's obviously geared towards the insurance side of it. Something that somebody out there that may not have, they may be that other 50% that don't like to insure, that kind of thing. Just to kind of encourage them and educate them on why they probably need to, pop into this with insurance. So, I mean, do you have a couple stories?
I mean, I love the co-insurance example that I always give to you guys, and we haven't really touched on it yet. But co-insurance is one of those things that if you go back and you look at your deck pages of your policy, and you've got 80, 90, or 100% co-insurance, which are the three options that are available to an investor. I say available, that are kind of tricked into having onto an investor's policy. You need to do everything you can to get rid of it. So go to your agent and find out what you have to pay to get an agreed amount policy, or certainly one that waives co-insurance. And the reason I say that is because co-insurance is just a tricky way for an insurance company to diminish the amount of money that an investor is going to recover following a loss by saying that you're underinsured at the time of loss. So Josh, if you go in and you sign up for insurance with a carrier and your contract says that you have an 80% co-insurance clause, you're telling them that you're agreeing to be insured to 80% of what they determine to be the true replacement cost of the property at the time of loss. That's the tricky part, right? Because so many factors can affect that, and replacement cost changes so drastically all the time. So if we go even to a partial loss, a kitchen fire that maybe causes $20,000 worth of damage, something minor, your adjuster is going to come out and they're going to figure out, hey, if this thing had burned to the ground, how much would it cost to rebuild? Let's just keep it nice and easy and say they determine it would cost $100,000. They're going to refer to the deck pages of your policy and say, hey, you're agreeing to be insured to 80% of what I just determined to be the replacement cost of the property. So provided you're insured to $80,000 or higher, you've met your co-insurance clause. However, if you're insured to under $80,000, then the company's going to assess a co-insurance penalty based on the percentage you're underinsured, and they do that prior to figuring in the depreciation or your deductible, so they can take it off a higher value. So the reason I kind of prefaced with that was I have a client that was not a client at the time, about 7 or 8 years ago.
So they are now.
They are now, yeah.
Okay, that's probably the story.
Yeah,
okay.
he should be a lot he should be a lot happier now. But he called me because his agent hadn't explained anything to him. He was insuring a house for $100,000, had 80% co-insurance, and was on actual cash value. And I think if I remember correctly, lightning hit the building, burned to the ground. It was a total loss. The adjuster determined it was going to cost $230,000 to rebuild that house. Well, as you can imagine, he's about over 50% underinsured. He's got actual cash value, so he's got depreciation, and he had a $5,000 deductible. So on a $230,000 total loss, it was insured to $100,000. He made $24,000.
Wow.
It's kind of hard to recover from that, right? So couldn't rebuild it, really couldn't. He lost a lot of money on the deal, obviously. Was able to sell the land. He's recovered very nicely. He was just starting out, had a handful of properties. I think he's got about 600 with us now in Kentucky and Ohio and Indiana. So done very well, but just not understanding. And it's not the investor's fault. It's the agent's fault. The agent didn't come to them and say, hey, yes, we're saving you money, but this is why. Cheaper is never better with insurance. Now, if he would have been okay and he said, hey, I've got couple $100,000 in the bank and I'm okay doing that, then by all means do it. But make sure that your investor's comfortable with that. Make sure that you're comfortable with that, and go to your agent and make them explain that to you of what loopholes can potentially get you in trouble following a loss.
Well, I don't know if I would say cheaper is never better, because that was the point I was actually going to get into next, because I got really educated and I felt like when I switched over to REI guard before it was NREG. And I felt like I was felt like I was an educated investor to a certain degree. And I was getting, I thought, a pretty good price. When I switched, I still end up saving 10 to 15%, what I would say. And I think a lot of people that I've talked to are actually saving more like 20, 25% when they
What's the
switch over.
differentiator with that though? Why did you save so much?
Well, I feel like I save, what I'm saying is I feel like I save less than what most people have. I just talked to an investor last week at the Financial Friends Network event that Shawn was at as well. And he said he saved between 20 and 25%. And I'm saying I save between 10 and 15%. And I feel like I even got better coverage and I understood it even better when I switched to NREG. So, you know, so from what I see is you guys do offer a really great product at competitive prices. And in addition to that, you're really educating the market. And that's what I really appreciate about you guys. And I mean, really, if you guys don't know, the company itself was created by an investor for investors. And I think that's really like, it shows in how they try to take care of the investor itself. You know, they're not really, I mean, they may take accounts, I'm not sure, from just regular homeowners, but that's not really the target that they're marketing to. They want investors, so they understand us a lot better than your typical insurance carrier who really is just doing, you know, house and car and life insurance and all that other kind of stuff.
Gotcha.
Yeah. And Josh, I can answer your question too. Tom made great points. And, you know, one of the things that we do that's kind of unique is, you know, if you go to another carrier, oftentimes they have maximum number of properties they can put on a given policy before you have to start a new one. Every carrier is different. It could be 1 up to 4. Sometimes someone has 6. They change from year to year, depending on what their exposure is and what their loss ratio is. But, you know, ours is being able to have literally hundreds of locations on one single schedule. All that's going to do is drive a property rate down for an investor. We leverage the portfolio size with our program underwriters to control the insurance costs.
Gotcha.
Yeah, so that's just another step that we don't even see, but you're doing it behind the scenes, and then you're passing along those savings to us instead of just writing one policy and then going to your underwriter with each individual policy. Well, now instead you're bringing 100 properties or however large your portfolio is, and then you're passing along the savings. So that's why year after year, I'm not seeing property increases. I might even be seeing decreases to a certain degree because I'm getting more and more properties.
Right.
Awesome.
The only increase that you may see, Tom, is when you and I talked earlier about, you know, you increasing a property from ACV to replacement cost, you're paying for the additional value per square foot on the same property rate.
Exactly.
Awesome. So you guys like to innovate a lot. I feel like almost every single time you guys come see us, you always have something new that's in the works.
Yep.
Is there anything that you can tell us that you're working on currently that you're allowed to tell us?
Come on, give us secrets.
Yeah, that's something new that's going to be coming out. You look like you're about to come through the screen. So
no, it's funny. It's funny you say that because Mike Jordan emailed me this morning about one that I'm working on with him that hopefully I can get set up and rolled out for everyone. And it's a rental guarantee product, which is a little bit. It's not a little bit. It's very difficult to get because the industry struggled with how to underwrite it, what to charge for it. It hasn't been very successful up until now. But it's kind of a renter's product on steroids, and it gives a stop rent payment, meaning that if your tenant defaults on the rent and they skip town and leave you holding the bag, then that would potentially pick up your lost rental income for a period of up to 3 months or whatever's left on the actual time of the lease.
Wow.
So yeah, it's difficult, guys. It's been a process, but it's really exciting to see that I've actually got some partners that are working on that with us. So when Mike sees, hopefully he's watching, he'll see it and enjoy it. So because he actually brought it to me. It's something we've been working on with some partners out of Dallas, but starting to come to fruition and getting organized, and hopefully she release it soon.
So having a renter's guarantee or rent guarantee policy.
Yep.
So why don't you just hit? I know we don't have a whole bunch more time. Why don't you just hit a little bit on the actual your portal that you've created for investors? Because I think this for us it makes it very super easy. I'm not sure if this is completely rolled out to everybody, but I know if it's not yet, you will be rolling it out soon.
Yeah, it's gotten to most of our clients. We had to do it in a process, right? Couldn't just blow it to everybody at once. We would have got inundated with phone calls because there's been a lot of questions, and we want to make sure we can spend enough time with every investor to make sure they're comfortable with it. But the advantage of the client portal is knowing that, hey, not every investor wants to talk to a live person every time that they need to make a change. So being able to log on and self-serve, you can add, delete, change coverages on your location in real time. You can pull certificates of insurance at any time that you need to. And in addition, checking out your inventory report pretty much whenever you need to. So looking at your per location costs that are allocated out per month per property. So it really just gives it, rather than, you know, having to drop an email and wait for one of our client service reps to come back, you can just log on at 2 o'clock in the morning if you want to and self-serve. Not for everybody.
Awesome, yeah.
Yeah, I mean, I know for us, it's been so easy. I mean, and really, they just have the questions there that you need to answer for each property to add, and it just, to me, it's instead, like you said, sometimes you have to sit on hold and wait for somebody you can actually talk to and go over it, and that sometimes that takes time. It helps us streamline our process, and again, just something else that you guys are doing to help investors, and I know that our people really appreciate that. So anyways, it's been really good for us.
Yeah, it's definitely like the part I was saying is like you guys like to innovate a lot and kind of adapt to what people are actually doing. And people kind of don't like talking to customer service on the phone anymore. Like if you can make it easy for them to just jump on the internet and, you know, make the changes there, like even with all the options that you've talked about, that's incredible that you guys have done that. So it's, like
I don't know.
Tom said,
I mean, we were on the phone
easy.
with Comcast yesterday for about 2.5 hours.
That was fun.
You don't like that?
But it's not for everybody.
We don't like it.
It's not for everybody. I mean, we have some of our investors that are just, we say it's old school, but they want to talk to their client service rep each and every time, and God bless them. We'll never take that away. We've got, you know, 60 of us that are all licensed, 60 or 70 now that are licensed right here waiting to answer the phone. So it'll always be an option, but it's really whatever is best for the investor.
Awesome.
Well, we really appreciate you being on with us, Shawn, and really, we are only looking for people to be a part of our mastermind that are like Shawn, that really do want to have the right kind of success and help other people have the right kind of success. And that's really what good success is all about. It's about having the right kind of success. It's about not just making a bunch of money, because insurance companies, where they do make a lot of money. But I believe that our NREG is really trying to help the community have the right kind of insurance, so that way when things do happen, they actually are covered. So, and to me, like, it's just full circle. You know, you're going to get back whatever you give, and you can't expect to plant an apple tree and get an orange out of it, right? So, like, if you're going to plant, trying to do the right thing and helping other people, what's going to end up happening back to you? And you can just definitely see it throughout the whole Affinity brand and all the other brands that you guys own and operate. And I just love being a part of your guys' community, and I love it when you guys are part of our community.
Yeah, and you guys have just done an incredible job, you know, finding a niche in the market and then just like taking advantage of that. So you guys are focused on investors. So you guys listening that are investors, you definitely, if you haven't, you know, talked to NREG, you definitely need to. So Shawn, anything else that we want to add on before we let you go here?
No, I appreciate it, guys, very much. And just mirror all Tom's comments. We love being a part of good success, and appreciate you guys very much.
Awesome. All right. So that's going to do it for today's episode, guys. Thank you so much for watching. If you're on the live stream right now, make sure you guys leave some comments below, share this around, give this video a big thumbs up. I felt like Shawn, we did a fantastic job with, yeah, there you go. Shawn did a fantastic job with explaining some things. I know it's a lot to take in, but I'm sure you guys have questions. Shawn, if they wanted to reach out to you or NREG, somebody that's going to be able to help them, how would they be able to do that?
Yeah, I'll just go ahead. I might regret this, but I'll give you my direct line that you can reach me is 816-398-4096, or you can go, you call toll free 888-741-8454.
Awesome. So he just gave you your direct line. That's big time. He's making a big jump right there. So,
and for some of you that actually have larger portfolios, Shawn will actually sit down with your portfolio himself and actually go over some of your properties with you. So if you have a couple hundred properties, I promise you Shawn would definitely be willing to help you. And that takes a special type of touch. Trust me, I understand that. But they've done that for us several times, and I've always appreciated it. So
thank you.
All right.
That's
going to wrap it up. So I'm going to mention back again to our May Mastermind. Shawn, are you going to be there?
Of course.
Awesome.
Absolutely.
So Shawn's going to be there, May Mastermind, May 9, 10, and 11. We're going to be in Chicago. So we keep it away from Chicago in the first and last quarter. And Shawn, you're in the Midwest, so you know why we do that. Absolutely. So anyway, but you guys are interested, go to goodsuccess.com/mastermind, and you guys can check it out there. Fill out the application if you're interested, and you can find out all the information there, or give us a call, email us, and we'd be able to talk you guys into it. So after that, in July, we're going to be having our Community Go Giver event. It's a mouthful, but Shawn is going to be there. We're going to have Walter Walford there, Jim Ingersoll, Jeffrey Taylor, Gary Harper, and Ken Lacey. Shawn, like I said, it's going to be a stacked lineup, and it's going to be all educational. So, like, no selling. This is to help the investor community to actually help build their community and to show them what we're going to be trying to do in Gary and working towards for that. So I know Tom's very passionate about flipping the city of Gary, and so that's why we started this event, is to actually, you know, show people what we're actually going to do to help flip our community. So if you guys are interested, go to communitygogiver.com. We'll have it linked below, and then that's all I have. So Tom, anything you want to share before we?
No, thank you so much for being on here, and God bless. I hope if there's anything we can do for you guys, just let us know.
Yep, and then we're going to have all of NREG's social platforms. I failed to mention that. We're going to have all of their social platforms linked below, so you guys, I believe you're on Twitter, Facebook, anything else that you guys are on?
LinkedIn.
LinkedIn? Okay, so we'll have them on LinkedIn as well, so you guys can, you know, follow them. They have a really strong community on their platform, so very helpful. So thank you guys for watching, and remember, whether you're looking to survive, thrive, or matter, our goal is to provide the tools to reach your vision. Thanks again for listening, and until next time.